As the stock market is trading at all-time highs, the most common question I get is, should I wait for stocks to crash before I buy? I completely understand this concern as you're trying to protect your investments, and it sucks to see your money fall so much so quickly, potentially in a crash. In this video, I'm going to provide you with two different answers. One on when to be cautious and another one on when to consider buying more. This is my famous stock market to GDP ratio going back to 1928. I made it based on the S&P 500 and its equivalence to before 1957 when the S&P 500 started. Guys, we're currently at 117.5% overvalued. That takes our fair valuation today to 2737. Now, those of you who are new to the channel are probably like, what the hell? That's over a 50% drop to get to normal levels. Guys, this is just data. I'm not sitting here saying this is 100% fact because things can happen. And I've been saying markets have been overvalued for a long time, even before we were at 3,000 on the S&P. What does that mean? Well, it just means that be ready for a bumpy ride ahead. 5 or 10 years from now, it probably won't be as good as the last 5 or 10 years, but it doesn't mean you stop. And I have a great piece of data for you coming up that will show you how valuable what I'm saying is. But you look at this, and you look at history based on undervaluation and overvaluation. When we're 40 or 50% or more overvalued, the next 10-year average is negative 0.2% on the S&P, not including dividends. Guys, we're 117% overvalued. This is just for 40 or 50% overvalued. When you're undervalued, look what happens. Your returns are much better. Guys, is it a coincidence that as we go from undervalued to overvalued, our returns go lower? It is not a coincidence. The more you pay for something, the less you make. The less you pay for something, the more you make. More on that shortly with even more incredible information. So guys, now this is the Mag 7. In our software, we have a great tool called the 8-Pillar Portfolio. It allows you to put certain stocks in, show them how many shares you have, and see how they look as an 8-pillar perspective. Okay, I made these basically all an equal-weighted portfolio on the Mag 7. Tesla, Google, Microsoft, Meta, Amazon, Apple, NVIDIA, they're basically 14 to 14.5% each. Guys, here's where we stand. The 7 largest companies in the stock market as a whole are selling for 54 and 59 times earnings and free cash flow over the last 5 years. My goal is to be under 22.5. Now, these are incredible companies. Everything else is a check. They have low debt. They have high free cash flow growth, high net income growth, high revenue growth, high return on invested capital. These are top quality businesses. But you've got to remember, a very true sign of investor is, do you think it's possible to overpay for a good thing? If you think yes, you're probably an investor. If you think no, you're probably going to be very, very poor soon. Now, guys, I don't mean that to be a jerk, and I don't think you're really going to be poor, but you're probably going to end up losing a lot more money than you'd like. The stocks that take the S&P and NASDAQ up are the ones that are going to bring it down. And this is not new. This is the way it is all the time. The biggest drivers of the market, when the tide finally turns, bring it down. But that gives you opportunity in the future. Now, let's go back to 2000. Guys, there are 3 companies I want to go over: Amazon, Intel, and Cisco. Intel and Cisco were the NVIDIA of 2000. They were the ones that everybody said, you cannot make money unless you have Intel and Cisco. They're absolutely a must for every portfolio. Well, guys, here's the max chart for Intel. See anything interesting here? All-time high, August 28th, 2000, $75 a share. It has not reached that point since. Now, you know what the interesting part is? As I'm sure you guys have seen me say before, in the last 12 months, Intel did $54 billion in revenue. Guess what it did in revenue back in 2000? $33.7 billion. So it's doing more revenue today than it did back then. And by the way, that $54 billion is after it fell a huge amount in revenue. It's trying to build itself back up. All right, let's go to Cisco. Cisco has the exact same story from a chart perspective. All-time high, March 27th, 2000, of $82 a share, has not seen that since. Well, let's go to the financials. Income statement, $53 billion in revenue in the last year. And in 2000, it did $19 billion. This is almost 3 times greater size company than it was back in 2000. If I told you in 2000, when you were paying $80 per share for Cisco and said, hey, the company's gonna be 3 times bigger, where do you think the stock price would be? You just said, oh my God, it's gonna be so much bigger. Would you have thought it'd be $57 25 years later? Probably not. And guess what, guys? It's not like it's selling for a super cheap amount of money. It's 20 times free cash flow and 25 times earnings. It just goes to show how overpriced things would be. Now, let's go look at Amazon. Amazon's a beautiful one because the most common thing I hear nowadays about Bitcoin or about these companies is I will never sell these companies. These companies are incredible. Well, guys, in order for stocks to go down, people have to sell them. That's what drives the stock price down. Amazon, what you're not going to see here is right back here. This looks like a chart that just goes straight up. Well, let's do a custom chart here. This is the chart from January 1st, 1998 to December 31st, 1994. Guys, this is many, many years. All-time high, split adjusted, $5.53 per share. The low, 28 cents per share. $5.53 down to 28 cents. If you think for 1 second that you'd have been the person that held this all the way down, I think there's gonna be a rude awakening. This is a 95% fall in stock price. And guess what? A lot of people said, oh, look, Amazon sucks. And now it's at $200, almost $200 a share. That's the point here, guys. The thing I keep repeating, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. So the lesson to be learned from this right now is to be cautious when buying individual companies. Buying individual companies can be a very tumultuous road because 1, you have to rely on that company. 2, the people out there in general are going to love or hate companies. And the ones that everybody loves tend to go up in price a little too far out of sync from valuation. And that can be difficult. And the ones that are falling, everybody hates and will blast and say, these things suck. And you have to sit there and be okay buying them. That's very, very difficult. Now, guys, this is the S&P 500 from January 1st, 1998 to December 31st, 2010. Look at this. It peaked in 2000. 11 years later, it had not reached its previous high. When you overpay for something out of whack, it can take a while to recover. There is a way to make money along this way, but it takes discipline. It takes just removing your emotions from the situation. That can be very hard to do. Again, I don't know what the next 10 years are going to look like. I have no idea. Do I think it's going to look like this? Probably, but I've been wrong for the last 3 years since COVID started. I've been saying markets overpriced again back in late 21, mid 21, early 21. You look at the saying, well, Paul's just a dinosaur. Maybe I am, but think about it logically. If this phone is worth $1,000, are you going to make more money paying $1,500 for it or $100 for it? If you don't understand that concept, you should not be investing money. The whole point is a good thing if you pay too much is a bad investment. That is the difference. Price versus value. My goal is to buy when value is above price, not the other way around. And right now, and for a while now, price has been above value, but as long as that keeps on marching like it did in the late 90s, it can feel like it's okay. Now, guys, this is the NASDAQ QQQ. This is back January 1st, 2000. It surged to start the year, and this is all the way in December of 2016. This is 16 years later. 16 years later, and it was about even. It took 16 years to recover. And in this time frame, it fell 83%. And guess what? At this point, people thought tech was dead. At this point, people told me Microsoft was a dead company and you shouldn't own it. At this point, Microsoft was one of the few companies you had to own in your portfolio. Microsoft's revenue and profit and QQQ's revenue and profit was much higher here than here. And yet people were following the stock price. That's what I want you to understand. Now, the good news is there's a way to make money off this, and you might be surprised how good the profit can be. It is going to blow your mind. Now, guys, this is an Excel sheet that I made investing on January 1st of every year going back to 2000. So remember, that's basically the peak of S&P 500 and the peak of the NASDAQ in 2000 up until today. Guys, the results are shocking. If you invest the same amount of money in the S&P, you would currently $6,000 a year, $500 a month from January 1st until now. You'd have $742,000 today, which is equivalent to 11.5% per year return. This 11.5% is amazing because you know what the actual S&P did from January 1st until now? 7.4% per year. This is outperforming the market by over 4% per year. How does that happen? Well, because you invested while stocks fell. And as you can tell, the returns get better as stocks are lower. And it's even more crazy for QQQ that took 16 years to reach its previous peak. If you dollar cost average $6,000 a year into that one, your returns were 15.32% per year, compared to 7.8% per year if you invested at the peak, which, by the way, is still an amazing number. Now, you might sit there and say, yeah, but Paul, you keep saying the market's overpriced. Exactly. Now, let me show you something interesting. Let's assume the S&P were to fall 50% from today, and QQQ were to fall 65% from today. What's the return difference as of right now? Well, dollar cost averaging in S&P, 6.85%. Dollar cost averaging in the NASDAQ, 8.46%. That's with a 65% fall in the NASDAQ as of this very second, and a 50% fall in the S&P, which, if those things happen again, it's compared to 4.69% on the S&P and 3.32% on the NASDAQ. So what does this mean? Dollar cost averaging works. It takes the thinking out of everything. All you have to do is just robotically buy good indexes at low cost. That's it. And if you do that, you will wake up a very, very wealthy person. You could have tried your hardest from 2000 until today, and I guarantee you, you would not have made 15.32% per year. I can absolutely guarantee that. So imagine buying an ETF that would give that to you. Now, you might sit there again and say, but Paul, this is all-time highs today. Yeah, but I had you starting at all-time highs as well. So I picked the worst time possible to start investing, and it still made sense. And I guarantee if we took these numbers back to 95, it would be even better. And that's the big thing, guys. And when it comes to retirement, I always use my retirement calculator, because the retirement calculator sits here and allows you to make assumptions about the future on your returns. And I always tell people, be more conservative in that regard. But imagine waking up 25 years from now, and after the market has fallen 50%, 60% in some cases, still being able to put in 7% returns for your worst case scenario. That's a pretty powerful place to be. Now look at this amazing thing. The NASDAQ fell 83%. This is our NASDAQ part. If you had invested at the peak of the NASDAQ, you'd have made 546% of your money. 2 or 3 years later, when the NASDAQ bottomed, every dollar you put would have been 2,330% growth to today. That is an amazing number. So, for those of you who say, Paul, I'm a little bit of a risk taker and I understand these valuations, how can I really make money on that? Very simple. When our valuations are below historical, put more money in. Just put a little bit more money in. As it becomes more and more undervalued, put more money in. Find a way to add more money to the markets. And what you're doing is you're buying $1 of cash flow cheaper and cheaper and cheaper and cheaper. And if you do that, you are going to wake up so incredibly wealthy, because at some point, the markets will turn. In 2000, 2001, and 2002, the market had negative years all 3 of those years. That had never happened before. And then we went into a nice bull market. And then we had another bad year, really awful year. And then we went into a 15, 16-year bull market. Those will always happen eventually. Just like we will eventually have a bad market. We'll eventually have a long-term bad market. When? I have no idea. I'm currently buying stocks in this market, and I'm finding value, but it's very difficult. And I do believe that based on these numbers, all the companies I've bought today will be considerably lower than they are if what I think is going to happen does happen. And you know what I'm going to do? I'm going to buy more. I want to change your perspective from fearing overvalued markets and worrying about how to protect yourself from the next crash to being excited about the opportunity to buy stocks at cheaper prices. Morgan Housel always says, every past crash looks like an opportunity, every future one looks like a risk. Spoiler alert, they're all opportunities. The question is, can your stomach realize that? I knew many people who quit investing back in the 2000 crash. And many people around you today that say they'll never sell something absolutely will bail. they will stop investing when the next crash happens. It's not a matter of if, it's a matter of when. They will lament their losses and claim that Wall Street always comes out on top and there's some excuse because of blah, 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 blah. There'll be some bullshit story that everybody comes up with that will feel so incredibly true at that time. It'll feel so incredibly true. In 2009, the world was worried about having money. The world was worrying about banks all shutting down. If there's not more of a fear than that, then what is? And guess what? We came out to a bigger stock market for the next 15 years. But people who bail are those who fail. And you need to align yourself with like-minded people who won't quit. If you surround yourself with the people who think like this, you will do better in the long run. Take an offensive mindset when it comes to investing when you have a long-term time horizon in front of you. Surround yourself with the people heading in the direction that you want to go and never stop investing. When stocks fall, the vast majority of the lemmings out there will also sell off their holdings and they'll have every excuse in the book as to why they are. I had a conversation 2 days ago with two people about investing in Bitcoin, and both of them said they would never sell Bitcoin, ever. I thought to myself, I've heard this before. Guy Spear writes in his book, The Education of Value Investor, he had value investing friends who said, I believe in buying something when it's fallen in half. And guess what? They bailed. And he said, wait a second, what happened to our value investing principles? You're not meant to navigate this journey alone. Right now, guys, our community, our software, we're offering a 7-day trial at everythingmoney.com/signup. But it's not going to last forever. So take advantage of it while you can. Be ready to prepare yourself for when a bear market happens, whenever that is. Click on the link in the description to get access to everything we have to offer, all of our investing tools, the tools I use daily to make my better decisions, and more importantly, the community that's ready to support you when the market dips. It will be the best decision you've ever made.